For 22 years, Terry Keeley was one of the top bankers to central banks and sovereign clients, generating some $600 million a year in annual revenue for UBS. He knows a thing or two about currency intervention. There's a right way to do it, and there's a wrong way. Terry, who just opened his own sovereign advisory firm, Sovereign Trends, says the Bank of Japan is getting it mostly right, and he is here to tell us why. So tell us, Terry. A lot of people have some criticism for the Bank of Japan, including Jean-Claude Juncker, this morning saying, hey, if you're not doing it in a coordinated fashion, that's not really the right way to go about fixing imbalances. But you think they're actually getting it right for the most part?
Well, a lot of analysts over the last 24, 36 hours, Eric, have criticized the Bank of Japan for going it alone. No question, if you can do it in a coordinated fashion, it tends to be more powerful and more efficient. But we have a number of examples of unsuccessful coordinated intervention and a number of examples of successful uncoordinated intervention. And I think in this case, the Bank of Japan got the latter.
Okay, so explain to us how you go about doing it right, so to speak, and maybe we'll use Japan as an example for the right, and you can highlight some examples of maybe getting it wrong.
So the sine qua non, right, for successful currency intervention is that you intervene in the direction of the intermediate term equilibrium rate. Lots of big words, but the bottom line is, as you say, get the price right. If you're buying low and selling high, that's a good trade, and broadly speaking, that's what the central banks are trying to do. In the case of Japan, they've intervened at a level around 82, 83, 25% higher than the equilibrium rate over the last 10 years. That's a pretty good entry point. And most importantly, what sovereigns need to do is get the direction right on cross interest rates and macroeconomic data. And I do think the Japanese are going to find that cross interest rates and macroeconomic data will favor a weaker yen over time.
Okay, so they didn't have coordination, but they did have the element of surprise going for them as well. Who doesn't get it right?
Well, the truth of the matter is that central banks are growing their foreign exchange reserves in many, many countries. They don't want to call it intervention, but that, in fact, is what it is. We clearly have an example, though, over the last year in the Swiss central bank of very, very active intervention, the first time in 20 years, that, quite frankly, is not a terribly Swiss characteristic, but something that perhaps they didn't time as well as they could have.
Okay, let's talk about what happens from now on.
Right.
The Japanese, so far as we know, have only been in on one day. We don't know how many times.
Right.
We don't know how much they spent. We don't know what they bought, whether it's dollars and euros or just one or the other.
Right.
So they're accumulating these foreign reserves on their balance sheet. The Bank of Japan is. What do they need to do right to ensure that this is a successful intervention?
Well, they've got to get the data right. They've got to, unfortunately, know the unknowable. And that is the only, those are the only circumstances in time which will prove them right. The truth of the matter is that the element of surprise is critical because it allows them to get where they want to go with spending the least amount of money. Plaza Accord, the 25-year anniversary, is coming up next week, September 22nd. The yen began a 51% move, Eric. Do you have any idea how the 5 coordinated central banks spent to do that? $10 billion. To get a 51% move on $10 billion, that's a successful intervention. You say we don't know how much the Japanese spent. Could be between 10 and 30 billion. I suspect it's right in the middle. The 2.5%, 3% move they got, relatively successful. But more importantly, what's going to happen over the next 6 months?
Okay. We are back with Terry Keeley of Sovereign Trends. We were talking about the Japanese yen intervention. Now it's time to turn our attention to the Chinese yuan. Tim Geithner is going to be on Capitol Hill today. As you know, Terry, he's going to be making the case for why China needs to allow the yuan to strengthen because of what it's doing to the U.S. You're going to make the case right now why China needs to act in its own interests by doing the very same thing.
Correct, Eric. You know, it's poorly understood, I think, that central banks, broadly speaking, are banks. So against all these assets, foreign exchange assets, they have liabilities. Typically, for an emerging market central bank, their liabilities are denominated in their home currency, and their assets are denominated in the hard currencies. Nominal rates between those two create an absolute witch's brew for negative carry. The cost of holding reserves in a country like China or Russia or India is extremely expensive, and you have to find a way to get paid for that.
And on the 2-year Treasury, you're earning 50 basis points. So they're behind the 8 ball right out of the box. what about going forward? What are they likely to invest in order to try and make up some of that gap?
It's been a tough couple years, Eric, in the markets, as you know. So the process of asset diversification into higher yielding instruments, they tried Fannie and Freddie, then they tried equities. Here I'm not talking specifically about the Chinese, I'm talking more generically. And what you have through this asset diversification process, candidly, is growing mismatches, growing risks. Is it going to work out? Is it not going to work out? My bet would be take all that risk off the central bank balance sheet. You want to do what the Fed does. Keep very, very few foreign exchange reserves, not more than you need. Foreign exchange reserves are not a sign of strength. In many cases, particularly in the case of the Chinese, it's a sign of weakness.
That's an important point. So you effectively are arguing for the Chinese to abandon the peg, stop holding U.S. Treasury bonds. I mean, the implications of this are enormous. I don't need to tell you.
Well, the central banking world has changed so dramatically in the last 2 decades alone, last 2 years, but the 2 decades. We now have 20% of global GDP that is implicated by central bank balance sheets. That's the average size of a central bank balance sheet. That's versus 3-4% when Alan Greenspan became chairman. The important issue to understand, Eric, is that we're talking about exit strategies for quantitative easing. For many of these central banks holding massive reserves, we should also be talking about exit strategies for those reserves. Otherwise, the losses will be catatonic for those institutions and the countries that bear them.
Terry, thank you for joining us, folks. I do want to remind you, Terry Keeley has more than 2 decades of experience advising central banks. He just started his own firm, Sovereign Trends, and as you just heard, some very strong words for the Chinese.